Preparing for a financial analysis at Vodafone interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Vodafone? I am attracted to Vodafone because telecommunications combines essential services, recurring revenue, major capital investment, and rapid technological change. The analyst role would let me connect financial results with customer behavior, pricing, network investment, and operational efficiency. I also value Vodafone's international scale and transformation agenda because they create complex analytical questions rather than routine reporting. My strengths in modeling, explaining variances, and challenging assumptions would help management make better decisions while developing my understanding of a strategically important industry. While answering, focus on Vodafone's telecommunications scale, recurring revenue model, transformation agenda, analytical culture, and how your technical skills can support commercial decisions, performance management, investment priorities, and long-term shareholder value. Question 2. How would you analyze Vodafone's financial performance? I would use a driver-based approach rather than looking only at headline profit. First, I would examine organic service revenue growth by geography and segment, separating price, volume, mix, and foreign exchange effects. Then I would assess EBITDA margins, operating cash flow, capital expenditure, free cash flow, and leverage. I would reconcile results against budget, prior periods, and guidance, investigate material variances, and connect financial outcomes with operational indicators such as customer numbers, churn, ARPU, and network usage. Make sure to cover revenue growth, organic versus reported movements, EBITDA and margin trends, cash conversion, leverage, capital expenditure, regional performance, customer metrics, guidance, and comparison with budgets, history, and competitors. Question 3. Which key performance indicators are most important in a telecommunications business? The most useful KPIs combine customer economics with financial outcomes. I would monitor service revenue growth, ARPU, churn, net additions, customer acquisition cost, data usage, and customer satisfaction. On the financial side, EBITDA margin, capital intensity, operating cash flow, and free cash flow are important. I would interpret them together. Aggressive promotions may increase additions but reduce ARPU, while network investment can temporarily weaken cash flow yet improve retention, usage, and pricing power over time. In your answer, talk about service revenue, average revenue per user, churn, net additions, customer satisfaction, data usage, EBITDA margin, capital intensity, cash flow, network quality, and how KPIs interact rather than operate independently. Question 4. What is the difference between reported growth and organic growth? Reported growth is the movement shown in the financial statements, including acquisitions, disposals, currency translation, and accounting changes. Organic growth attempts to show underlying performance on a comparable basis, typically excluding those effects and using constant exchange rates. For example, reported revenue could decline because sterling strengthened against another currency even while local currency customer revenue grew. I would present both measures, explain the bridge clearly, and avoid treating organic growth as a substitute for statutory reporting. Be sure to mention acquisitions, disposals, foreign exchange translation, constant currency analysis, comparability, management reporting, and why organic growth usually provides a clearer view of underlying operating performance. Question 5. How would you build a financial forecast for Vodafone? I would build the forecast from operating drivers upward. For each market, I would model customers, churn, net additions, ARPU, pricing, usage, and service revenue, then forecast handset sales, operating costs, energy, personnel, network investment, working capital, and taxes. I would document assumptions, validate them against history and commercial plans, and create base, upside, and downside cases. After each reporting cycle, I would compare actual results with forecast, explain variances, and refresh assumptions rather than mechanically rolling forward errors. Focus on segment-level drivers, customer volumes, churn, ARPU, pricing, usage, cost inflation, headcount, network investment, working capital, foreign exchange, scenario assumptions, historical calibration, and regular variance-based model updates. Question 6. How would you explain a decline in EBITDA margin? I would first quantify the movement and separate recurring from exceptional items. Then I would bridge the margin change through revenue mix, pricing, promotions, customer acquisition costs, energy, people costs, supplier inflation, roaming, and any restructuring charges. A lower margin could reflect deliberate investment in growth or a structural loss of pricing power, so I would compare performance across markets and periods. Finally, I would assess management's mitigation actions and whether cash flow is being affected similarly. Make sure to identify revenue mix, pricing, promotions, inflation, energy costs, roaming, wholesale economics, restructuring, one-off items, operating leverage, and whether the decline is temporary or structural. Question 7. What is ARPU, and how can Vodafone increase it? ARPU means average revenue per user over a defined period, usually calculated by dividing service revenue by the average customer base. Vodafone can increase it through pricing, higher value plans, additional data, converged mobile and broadband bundles, digital services, and targeted upselling. I would not pursue ARPU in isolation, because aggressive price increases can raise churn or reduce customer lifetime value. The best analysis considers ARPU, retention, gross margin, acquisition costs, and competitive response together. In your answer, define average revenue per user, distinguish customer mix and pricing effects, discuss upselling, bundles, data usage, premium services, contract migration, retention risks, and the relationship between ARPU and lifetime value. Question 8. How would you analyze customer churn and its financial impact? I would segment churn by market, product, contract type, tenure, customer value, and reason for leaving. Then I would estimate the revenue and margin lost, the cost of replacing customers, and any effect on network utilization. A targeted retention offer may be worthwhile for a high-value customer but uneconomic for a low-margin segment. I would compare churn trends with pricing, service quality, competitor promotions, and customer satisfaction, linking the analysis to lifetime value rather than revenue alone. Focus on churn definition, voluntary versus involuntary losses, customer cohorts, contract type, acquisition costs, ARPU, retention economics, competitor activity, lifetime value, and the distinction between short-term revenue and long-term profitability. Question 9. How do capital expenditures affect Vodafone's financial statements and valuation? Capital expenditure is a cash outflow used to acquire or improve long-term assets, such as spectrum, networks, and technology infrastructure. It generally does not reduce EBITDA immediately, but it reduces cash flow and creates future depreciation and amortization. I would assess CapEx intensity, project returns, capacity needs, asset utilization, and timing. In valuation, sustained investment can support growth and customer retention, but investors will question projects that consume cash without improving returns or competitive positioning. Be sure to cover network investment, capitalization versus expensing, depreciation, cash flow timing, EBITDA, free cash flow, asset productivity, spectrum spending, and how returns on investment influence valuation decisions. Question 10. Explain free cash flow and why it matters at Vodafone. Free cash flow represents cash generated by the business after operating needs and capital expenditure. It matters at Vodafone because it funds debt repayment, dividends, spectrum purchases, acquisitions, and strategic investment. I would reconcile it from EBITDA through working capital, cash taxes, interest, restructuring, and CapEx, rather than assuming EBITDA equals cash. I would also distinguish recurring free cash flow from one-off benefits or payments, because sustainable conversion is more relevant to financial flexibility and valuation. While answering, define operating cash flow less capital expenditure, distinguish accounting profit from cash generation, discuss working capital, spectrum and restructuring payments, debt service, dividends, and the importance of sustainable conversion. Question 11. How would you assess whether Vodafone should invest in a new network project? I would evaluate the project using incremental cash flows, not allocated historical costs. Benefits might include additional customers, higher ARPU, lower churn, greater data capacity, wholesale revenue, or operating savings. I would calculate NPV and IRR using an appropriate discount rate, then test adoption, pricing, CapEx, timing, and terminal assumptions. I would also consider strategic and regulatory benefits that may not appear immediately in the model, while comparing the project with competing uses of Vodafone's capital. In your answer, discuss incremental revenue, cost savings, customer retention, coverage, capacity, NPV, IRR, payback, sensitivity analysis, implementation risk, strategic benefits, and opportunity cost versus alternative investments. Question 12. What financial impact could a major Vodafone acquisition have? I would start with the purchase price, financing mix, target earnings, cash flow, and valuation multiples. Then I would model revenue and cost synergies, integration costs, regulatory remedies, working capital, and timing. Purchase accounting could create goodwill and identifiable intangible assets, affecting future amortization and reported earnings. I would assess leverage, interest coverage, free cash flow, and earnings accretion or dilution under multiple cases. The central question is whether risk-adjusted returns justify the price and execution complexity. Make sure to cover purchase price, funding, synergies, integration costs, goodwill, intangible assets, depreciation, amortization, leverage, accretion or dilution, regulatory remedies, and execution risk. Question 13. How would you compare Vodafone with its competitors? I would first ensure the comparison is like for like, adjusting for geography, reporting periods, currency, accounting policies, and business mix. I would compare service revenue growth, ARPU, churn, EBITDA margin, CapEx intensity, free cash flow conversion, leverage, and valuation multiples. I would also examine spectrum holdings, network quality, convergence, and market structure. A lower multiple may reflect weaker growth or higher risk, but it could also represent an opportunity if the company has credible operational improvement and cash flow catalysts. Focus on comparable geography and accounting, service revenue growth, ARPU, churn, EBITDA margins, CapEx intensity, leverage, spectrum position, network quality, customer mix, and the limitations of simple multiple comparisons. Question 14. How would a 10% increase in energy costs affect Vodafone? I would identify the portion of network and facilities costs exposed to energy prices, then apply the increase to the relevant cost base rather than total operating expenses. I would model the direct EBITDA and margin impact, plus cash flow and any effect on guidance. Next, I would review hedges, supplier contracts, efficiency projects, renewable sourcing, and pricing flexibility. I would present base and downside cases because the timing of contract resets and mitigation actions may materially change the final outcome. Be sure to mention network energy consumption, operating cost sensitivity, EBITDA and margin effects, pass-through limitations, hedging, efficiency initiatives, scenario modeling, and potential consequences for pricing, CapEx, and cash flow. Question 15. What is the difference between EBITDA and EBIT, and why are both useful? EBITDA is earnings before interest, tax, depreciation, and amortization, while EBIT includes depreciation and amortization. EBITDA helps compare operating performance before financing and non-cash asset charges, which is useful for a capital-intensive telecom group. EBIT better reflects the cost of consuming network assets and spectrum-related intangibles. I would use both, alongside operating cash flow and free cash flow, because EBITDA can overstate economic performance when substantial recurring capital expenditure is required. In your answer, define both measures, explain depreciation and amortization, connect EBITDA with operating performance and cash generation, discuss capital intensity, and note that neither measure replaces statutory profit or cash flow. Question 16. How would International Financial Reporting Standards 16 leases affect Vodafone's financial analysis? Under International Financial Reporting Standards 16, most leases create a right-of-use asset and lease liability on the balance sheet. Instead of recognizing the entire lease expense and operating costs, Vodafone generally records depreciation and interest, which raises reported EBITDA but does not change total cash paid. I would therefore adjust leverage, CapEx, cash flow, and peer comparisons consistently. I would also distinguish accounting presentation from economics, since the business still has contractual lease commitments and financing-like obligations. Focus on right-of-use assets, lease liabilities, EBITDA presentation, depreciation and interest, cash flow classification, leverage metrics, comparability, and the need to understand reported versus adjusted performance. Question 17. Tell me about a time you found an error in a financial model. During an internship, I noticed that a forecast's working capital balance was improving despite rising revenue and unchanged payment terms. I traced the formulas and found that 1 month had been omitted from the receivables roll forward. I corrected the model, recalculated cash flow, and clearly explained the impact to my supervisor before the analysis was circulated. I then added balance checks, a monthly movement bridge, and an independent review step. The experience reinforced that good modeling requires controls, not just accurate formulas. While answering, use a concise star structure, explain the control or review step, quantify the potential impact, describe how you corrected and communicated it, and show the preventative process improvement. Question 18. How would you handle conflicting priorities from finance and commercial stakeholders? I would clarify the decision each stakeholder needs to make, the deadline, and the minimum information required. I would rank requests by business impact, regulatory importance, and time sensitivity, then agree realistic deliverables rather than silently accepting conflicting deadlines. For example, I might provide a concise preliminary forecast first, followed by a fully reconciled version. Throughout, I would communicate assumptions and limitations, escalate genuine conflicts early, and never compromise controls or accuracy merely to appear faster. Make sure to cover clarifying deadlines, understanding decision importance, separating urgent from material work, agreeing scope, communicating trade-offs, protecting accuracy, and maintaining a transparent audit trail. Question 19. How would you value Vodafone using an enterprise value to EBITDA multiple? I would calculate enterprise value as equity value plus net debt and other debt-like claims, then divide it by a consistent EBITDA measure. I would select comparable telecom companies with similar geography, growth, margins, leverage, and accounting treatment, preferably using forward EBITDA. Vodafone's appropriate multiple would depend on its growth outlook, cash conversion, spectrum position, and execution risk. I would test sensitivities and cross-check the result against discounted cash flow, precedent transactions, and equity-based metrics. In your answer, explain enterprise value, EBITDA, peer selection, forward versus trailing metrics, lease and accounting adjustments, growth and risk differences, sensitivity analysis, and why multiple valuation should be triangulated. Question 20. What would you do if your analysis contradicted management's forecast? I would first validate the data, period definitions, accounting treatment, and model formulas to ensure the disagreement was genuine. Then I would identify the precise assumption driving the difference, such as churn, pricing, costs, or foreign exchange. I would discuss it constructively with the relevant stakeholder, present the evidence and sensitivity cases, and ask whether management had information I had missed. If the difference remained, I would document both views and recommend a monitored scenario with clear trigger points. Be sure to mention validating data and definitions, checking model logic, understanding management assumptions, presenting evidence respectfully, quantifying scenarios, documenting differences, and supporting a decision without becoming unnecessarily adversarial. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.